prices slide after weaker than expected Chinese growth data dents demand hopes. Welcome to Trading at Noon. I'm Ramzan Karmali. Oil prices dropped after weaker than expected Chinese GDP data fueled concerns over demand in the world's biggest importer. Prices fell after China reported its economy grew 6.3% year-on-year in the second quarter. That was 1 whole percentage point lower than expected. Before today, both benchmarks had notched 3 weeks of gains and touched their highest since April last week. Well, to take a closer look at the oil market, we're joined now by Homayoun Falakshahi, Senior Commodity Analyst at Kpler. Homayoun, many thanks for joining us. Let's start with China. Markets seem very concerned about the Chinese economy and the amount of demand China will have for oil. Are they right to be concerned?
Hi, and thanks for having me. Yes, indeed, and that's because China still is the main engine growth of oil demand this year. So, despite Chinese economic data disappointing, we still view Chinese oil demand growing by about 600,000 barrels per day this year, which is still by far the highest on a country per country basis. But if you look at what has happened in the past 2 months, we've seen very strong import levels and inventories in the country building quite strongly. Now, in May, this is quite normal because a lot of the refineries were offline. There was a lot of maintenance going on, but that has continued to build in the past 2 weeks in July, and we're now at more than 2-year high in terms of inventories. So I think until we see inventories coming down, then the oil market will still remain quite disappointed with China.
Well, up until today, there's been a bit of a rally in oil prices, mainly driven by production cuts. Are you confident that Russia and Saudi Arabia, perhaps they might come back in and announce more cuts going forward?
I don't think that's the case, and that's because they're already doing a lot, especially Saudi Arabia. I think it's very important to look at the export levels from Russia, which have been falling off a cliff over the past 2 months, down from almost 4 million barrels per day in terms of seaborne oil exports 2 months ago to a bit more than 3 million barrels per day now. Now, this is mostly the result of the refining sector in the country back also from maintenance. But I think it's, again, important to look at these levels to see if Saudi Arabia basically is happy with the cooperation from Russia, because Saudi Arabia is already doing a lot. Now, what's really important also to look at is the fact that Saudi Arabia now every month has the ability to extend its extra voluntary cut, and this is where we could actually see some bullish factor playing into the market again.
And what other production factors do you think investors and markets should be aware of at the moment?
So obviously this decline in production from Saudi Arabia and in exports from Russia, but also from other places in the Middle East, such as Kuwait, has seen especially the medium sour crude market, come down, reduce in terms of volumes in Asia, meaning that we expect quite a tight market, especially in the summer. And now you have 2 other main producers of medium sour or heavy sour crude, which are Iran and Venezuela, where there's not so much upside left from these countries because production and exports have been increasing lately, and we don't expect a big upside from these places in the next 2 months. So I think that looking in the summer, that means that the market should remain quite tight, at least in terms of fundamentals. But it really depends on hedge funds and other players in the market shifting their focus away from Chinese economic data up to the fundamentals. And that's not the case yet.
Homayoun Falakshahi from Kpler, many thanks for that.